the debt profile is rising, and especially in the recent years when we've had a slump in oil prices, the government had to borrow to make up for those shortfalls. Recently, he had actually issued an Eurobond, Nigeria issued an Eurobond to refinance the local treasuries, which were higher coupon. But one of the areas that we are beginning to see some traction in terms of growth of the debt portfolio is China loans. And of course, there's been an outcry that, why are we going so much to getting loans from China? Are we mindful of the debt trap? To me, there's very limited options that we do have in Africa.
I was going to say, what are our alternatives?
Absolutely.
I'm looking at a Moody's report which says that lending to Sub-Saharan economies by China has increased to over $10 billion annually from between 2012 to 2017.
Correct.
And that's from just about less than $1 billion in 2001.
Absolutely.
So what's the alternative? Well, if Nigeria says no more Chinese loans, where do we go? What do we do?
That's a big question. I don't know where you could actually, raise the kind of money that you're getting from China, especially since it's earmarked for infrastructure. You can fund large-scale infrastructure projects such as railway, ports, or anything of that nature today without having to borrow. Now, if we had a deeper capital market, maybe you could actually fund that internally. We do have a pretty sizable and growing pensions market, but not a lot of money from the pensions funds is coming into infrastructure. So China is one of our only options, unfortunately. But we also do have Eurobonds, which pretty much you tap that market to fund your budgetary shortfalls. And but I like the fact that when you borrow, it's tied to project, and it just makes it more prudent, if you ask me. How you manage that process is now your own problem.
So I was speaking to one of the advisors to the president on economic affairs, Dr. Dipeolu, recently, and he did say to me that as far as Nigeria's debt portfolios go, we're in good standing. So my question is, what's your point of view? Is the Nigerian debt portfolio a problem, or is it the fact that we're going to China to acquire more loans that is a problem?
I think the debt portfolio, especially when you look at the size of our debt vis-a-vis our GDP, it's still quite reasonable compared to a lot of emerging market countries. However, where the problem is the interest payments on those debts and what they call debt to loan service ratios. That ratio is actually creeping up. We're paying somewhere up to 20% or more of our annual budget just to service loans, and that is not good. But borrowing from China remains a marginal, portion of our total debt portfolio right now. And the difference is that it's directly targeted to infrastructure. And
exactly.
It historically hasn't been that case. So maybe if China was much more open in previous years where we had borrowed for infrastructure, maybe we might have had a better, infrastructure scenario right now. But unfortunately, this is something that we just started, and then we'll see how it plays out going forward.
So China says that they are willing to renegotiate loans with, as far as Sub-Saharan Africa goes. To what extent would you say that their willingness to renegotiate the loans and the terms influence the credit profiles of countries in Sub-Saharan Africa?
You have to be mindful of one thing. The nature of markets and economics is cyclical. And so we have this boom-bust cycle. You have, Africans are primary markets. They export primary goods, commodities, metals, minerals. Those products go through cyclicality that, you might have a better market environment when the prices are high, and then things slump. When the slump occurs, countries, creditor nations, including China, must be open to renegotiate. So yes, Nigeria has a serious debt situation in its hands right now, which if you look at the ratio of that to the GDP, it's not that high. But at some point, if you do have some shift in the market, Nigeria and China and whoever is a creditor and debtor must be willing to renegotiate. So the fact that China is open to that, I think, is a welcome development. The rigidity that you might have seen being who they are, to say, you know what, you take it or you leave it, or we call up the loans, or we come and acquire the assets. If that is not the case, then I think Africa can get away in a way, with some of those debt situations.
So the Moody's report says that China financed infrastructure investment should provide boost to long-term economic growth across Sub-Saharan Africa. So say Africa decides to look the other way, away from China. What would they be sacrificing on the altar of saving debt, portfolio debt situation? Should they give up prospects for long-term economic growth from a willing lender who is also willing to renegotiate?
My answer is simple. You can't sacrifice long-term economic growth. It's that simple. Prospects and catalyzing your economy takes infrastructure. Investing in infrastructure takes quite a bit of money. Now you have to ask yourself, in the modern scenario, where will that heavy capital come from? China is highly capitalized. They do have a solid, forex reserve, which they're willing to deploy to boost economic development in Africa and also boost consumption. Remember, when they're building your railway, some of the rolling stocks and some of the products and equipment are imported from China. So in a way, they are investing in Africa to boost long-term prospects that would in turn benefit them. What are the options? We've seen a little bit of action from the colonial masters. France being active in Francophone countries and UK being, but beyond that, we haven't seen much of activities from the Western world into Africa, and that's a void which China is filling.
So let's bring it closer home now. So hypothetically speaking, Nigeria says, following the currency swap deal agreement, loads of infrastructure loans from China, we are getting choked and we are backing off. Where do we look to?
I have to tell you that it's early to actually assert that we're going to be choked. The ratios don't look that bad.
We're not choking yet.
No, we're not choking yet. Especially on the infrastructure-related loans, we're not choking yet. We're choking on the domestic loans and the Eurobonds that we're paying high interest rate. And if you look at the Moody's report, by the way, we're also still at the lower ebb